Okay, so you want to own a cigar lounge. You've been a member of one. You've sat in the leather chair with the good lighting, ordered the padron and thought, this isn't a business. This is a lifestyle with a cash register attached. And you're not entirely wrong. There are now over 4,200 cigar lounges operating in the United States, up more than 4% in the last year alone, and the industry has grown at better than 7% a year since 2020. Combined, they pull in over $2 billion a year from roughly 12 million adult cigar smokers. That's a real growing market. There is just one problem. The lounge you're picturing, the one with the wraparound humidor and the regulars who tip well and never leave, isn't quite the lounge you're about to build. Because before a single cigar is sold, you're going to run into 3 walls most people never see coming, and all 3 of them are expensive. Let's talk about what it actually costs to open the doors. And more importantly, what's left after the walls, the state, and your own inventory get paid. Say you want to open a mid-sized cigar lounge in a decent part of town. Not a strip mall smoke shop, an actual lounge, leather seating, a proper humidor room, maybe a small bar in the corner. A modest build-out like that runs somewhere between $150,000 on the low end and $500,000 or more once you add a full bar, private rooms, and real furnishings. Some financial models for a full whiskey and cigar concept put the number even higher, north of $700,000 once you count build-out, opening inventory, and 6 months of operating runway. That's before you've sold a single stick. And here's the part that catches people off guard. The single biggest line item most first-time owners underestimate isn't the furniture, and it isn't the cigars. It's the air. A cigar lounge is legally a room full of smoke, and every city, county, and state has an opinion about that. You need a commercial-grade ventilation and air filtration system engineered specifically for tobacco smoke. Not a retrofitted HVAC unit. Budgets for that system alone routinely run $25,000 to $150,000, depending on square footage and local code, and it's not a suggestion. Fail the inspection and you don't open. Miss the smoke clearance rate your jurisdiction requires and you don't open. Some cities have banned indoor smoking lounges entirely, unless you're grandfathered in under an old exemption, which means the zoning map, not your business plan, decides whether your dream location is even legal. So before you've poured a single pour, you may have already spent 5 to 6 figures, just proving to a building inspector that your smoke won't leave the room. Let's say you clear that hurdle. The humidor's built, the chairs are in, the ventilation passed inspection. Now you need inventory, and this is where a lot of new owners make their first real mistake. They underbuy, thinking they'll restock as they go. Industry veterans will tell you the opposite lesson, usually the hard way. One lounge owner recalled starting with roughly $80,000 opening cigar inventory over a decade ago, and having to expand it almost immediately, because it simply wasn't enough to keep serious smokers coming back. A shallow humidor reads as a shallow business, to the exact customer you're trying to keep. So realistically, budget $50,000 to $100,000, just to stock a humidor that doesn't feel empty by month 3. Now the lounge is open. Members are walking in, cigars are moving. Here's what happens to that revenue, and this is the part that breaks the wealth fantasy people walk in with. Cigar retail margins are thin. Premium, hand-rolled cigars are expensive to buy wholesale, and the markup a lounge can charge without pushing customers toward online retailers is limited, typically landing somewhere in the 30 to 40% gross margin range once you account for import costs. And that's assuming you can even get the cigars you want, which brings us to the part of this industry almost nobody outside it understands. Here's the part that breaks people's brains. When you sit in a lounge and pick a Cohiba, a Partagas, a Macanudo, a Cazo, or a punch off the shelf, you're not buying from some small batch artisan operation in a jungle somewhere. You're buying from General Cigar Company, based in Richmond, Virginia, which is wholly owned by a Danish conglomerate called Scandinavian Tobacco Group. STG holds somewhere north of 30% of the entire U.S. premium cigar market by itself, and its brand portfolio spans more than 200 tobacco labels worldwide. Last year alone, General Cigar launched 124 new cigar variants, and those new releases delivered a full 1/7 of the company's net sales, all by itself. Its closest rival isn't some other boutique operation either. It's Imperial Brands, the British tobacco giant, which owns Altadis USA and with it the U.S. trademark rights to Monte Cristo, Romeo y Julieta, Upman, and Trinidad. Between those two European conglomerates, and a handful of independents fighting for the scraps, the top 5 cigar brands in America account for roughly 60% of the entire market. 2 out of every 3 premium cigars sold on Earth are sold in the United States, and a disproportionate share of them are made by companies headquartered in Copenhagen and London, wearing Cuban-sounding names on the label. The lounge feels like the last independent, romantic corner of American retail. It mostly isn't. It's the retail front for 2 European tobacco conglomerates, who've simply gotten very, very good at making that feel untrue. And it goes deeper than the humidor. General Cigar doesn't just sell you the product. It also runs its own lounge, club, Macanudo, a cigar bar in Manhattan built by the same company that manufactures the cigars on your own shelf. So even the concept of the independent cigar lounge has a version owned outright by the manufacturer, a company that doesn't need your markup at all because it made its money the moment the cigar left the factory. Now here's what that means for the lounge you're trying to build. Allocation. The most sought-after limited-release cigars, the ones members actually show up for, are rationed out by these companies based on sales history and relationships, not simply who can write the biggest check. A brand new lounge with no track record often can't get meaningful allocation of the cigars its members actually want in year 1, which means the products most likely to drive foot traffic are sometimes the hardest ones for a new owner to even get on the shelf. You built the room, you paid for the humidor, the company decides what goes in it. So if cigar sales alone won't carry the lounge, where does the real money come from? This is why almost no cigar lounge that survives past year 2 is actually a cigar business. It's a membership business that happens to sell cigars. Initiation fees, monthly dues, locker rentals for members who store their own private stock, private event bookings and bar revenue. That's where the real margin lives. Bar and beverage programs routinely carry 60 to 70% gross margins, nearly double what the tobacco itself returns. A well-run lounge might need 150 to 300 dues, paying members just to cover fixed costs, before a single walk-in customer buys anything, and locking in that recurring membership revenue is the difference between a lounge that survives a slow February and one that closes in March. And then there is the risk most new owners never price in until it's too late: insurance and liability. Tobacco-friendly businesses pay a premium on commercial insurance that a regular bar or restaurant simply doesn't carry. And in a lot of markets, finding a carrier willing to write the policy at all takes real legwork. Add liquor liability if you're serving alcohol. Add the fire risk of an open flame product in an enclosed space, and your monthly overhead is carrying costs a coffee shop owner never has to think about. Meet Mike. Not a specific person, an archetype, because the American cigar lounge industry has a very particular success story that keeps repeating itself, and it rarely looks like a young entrepreneur with a business loan and a vision board. It looks like a guy who worked 20 years in finance or sales or construction, smoked cigars the whole time as a hobby, and finally had the capital and the customer relationships to open a lounge as his second act, not his first swing. Mike doesn't open with 300 memberships sold. He opens with maybe 40, mostly friends and old coworkers, and he tends the bar himself most nights for the first year, because payroll is the one cost he can actually control. He doesn't chase allocation battles with the big brands in year 1. He builds a reputation with what he can get, and lets the manufacturers come to him once the lounge is clearly not going anywhere. He treats membership dues as the business and cigar sales as the hook that gets people in the door. By year 3, Mike isn't rich. He's got a lounge with 220 members, a fully rented locker wall, a bar program quietly out-earning the entire cigar case, and a life that looks a lot better than his old commute. That's the actual outcome that repeats across this industry. Not a chain, not an empire. One well-run room that finally turns a real profit in year 3, run by someone who wasn't in a hurry. Stack it all up. Rent, the specialized ventilation systems maintenance contract, insurance premiums that run well above standard hospitality rates, staff, thin cigar, margins controlled by 2 overseas conglomerates, and the constant churn of membership renewals. And a cigar lounge that's doing well is often clearing something in the range of a modest, respectable profit. Not the money-printing fantasy the leather chairs suggest. Payback periods on a 6-figure build-out routinely stretch 3 to 5 years. Even when the lounge is full most nights, longer if opening gets delayed by permitting, because every month the doors stay closed is a month of rent and payroll, burning against zero revenue. Meanwhile, the U.S. luxury cigar market itself, the actual tobacco, was worth roughly 3 billion inches 2024, and is projected to double to $6 billion by 2035, growing at better than 6.5% a year. The market is getting bigger. It just isn't your lounge that captures most of that growth. It's the two companies that own the brands on your humidor shelf. So let's close the loop. You invest, say $400,000 into a mid-sized lounge, with a proper humidor and a small bar. Your build-out alone eats a third of that before inventory and opening costs. Cigar margins land in the 30 to 40% range. Thin enough that they alone won't carry the rent. And the inventory that would actually drive foot traffic is allocated by two European conglomerates, who don't know you exist yet. The real cash flow comes from membership dues, locker rentals, private events, and a bar program running nearly double the margin of the tobacco you built the whole concept around. Ventilation, insurance, and licensing aren't one-time costs. They're recurring line items that never go away and never get cheaper. And the lounge with the leather chairs and the good lighting isn't really selling cigars. It's selling a room, a membership, and a reason for someone to sit down for 2 hours, instead of one, while the companies that actually make the cigars, headquartered thousands of miles away, collect their margin the moment the box leaves the factory, whether your lounge has a good quarter or not. And that, it turns out, is worth a great deal more than the tobacco on the shelf.